Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Where would we be without Jamie Dimon? Bad loans as cockroaches. And this from his interview at Davos. Inflation is a bugaboo. Admittedly, I don't recall coming across bugaboo in Econ 101, so I looked it up. According to Webster, a bugaboo is an imaginary object of fear. I'm pretty sure inflation is not imaginary, but there is no question that it is an object of fear. Mr. Dimon was making the point that the Fed doesn't set interest rates, it moves rates as a fast follower, in his words, to trends in inflation. We do believe the uncertainty around inflation, the bugaboo, will be a key driver of market sentiment over the near term. More on that in a bit. This week, our three things are: 1. Bond vigilantes. Volatility has come to sovereign debt markets. What's next? 2. The cost of gloom. The Economist newspaper says it's the world's main economic risk. And 3. Biggest risks. Speaking of risk, here's what market participants believe pose the biggest risk to market stability. All right, let's dig a bit deeper. Bond vigilantes. So this week, all eyes on Davos, but the more consequential storyline impacting markets we thought was Japan and the sell-off in the JGB market. Japan's aggressive fiscal plans and the market's reaction to those bring back the specter of bond vigilantes, investors that sell bonds in response to inflationary fiscal and monetary policies. That brings us back to the U.S., where rising debt and deficits has become a point of concern among investors. And yet, the 10-year Treasury yield has settled into a quite constructive range between 4 and 4.5%. So just how vulnerable are markets to the deficit issue? Well, we're not all that worried. And the reason is growth and economic dynamism. The U.S. has those more than any other developed country. So the U.S. gets the benefit of the doubt that it can manage its debt and deficit situation. We would add that it's also helpful to have in your recent past a period where you actually got rid of your uncomfortably high deficit. That happened, of course, in the 1990s, when famously the Clinton administration promoted its triangulation strategy, a third way, adopting fiscal conservatism more typically associated with republicanism, while maintaining typically democratic social values. And while the deficit was a bit smaller then, near 5% as opposed to 6% today, cuts to spending and tax hikes eventually eliminated the deficit. Still, the echoes of the 1980s are everywhere with regard to this topic, and it was only a little over 2 years ago that the 10-year had spiked to 5%, with calls at the time that yields could reach 6% or more on the back of stronger than expected economic growth and persistent above-target inflation. Still, we don't believe bond vigilantes are lining up for a run at the U.S. All right, on to our second thing, the cost of gloom. So we've often examined the topic of sentiment as revealed in survey data and the disconnect it has with markets and economic activity. Over the past couple of years, U.S. consumer and small business sentiment has at times fallen to levels rarely seen in the past 50 years. And yet, economic growth has remained solidly positive, unemployment low, and stocks and residential real estate values buoyant, to say the least. Now, we'd be the first to say, wait a minute, you've lost sight of the bottom prong on that K-shaped experience. Fair point. We'd point out that we've also spent a lot of time acknowledging what we call our two economies, with very different experiences for the wealthy and the less wealthy. And clearly, survey data is not wealth-weighted. But is there something more to this story? The Economist explores the topic under a rather, gloomy headline: Pessimism is the world's main economic problem. The newspaper points out that this isn't just an American problem. Citing a new poll by consultant FGS Global, a survey of 20,000 voters and business leaders across 27 developed world countries, all countries show majorities who believe life will be harder for the next generation and that economies are rigged in favor of the rich. And in all countries but Denmark, majorities believe public institutions are ineffective and wasteful. But wait a second, you say. Sure, folks have found reasons to feel gloomy and displaced. Isn't this just another case of watch not what I say, but what I do? After all, global stock markets are just off of all-time highs, as is developed country wealth. So what's the problem? Well, the piece warns of political shifts that grow out of broad-based dissatisfaction, ones that promote security over growth. That means a gravitational pull towards populism. That means less fiscal discipline and less investment in the future. That means rising protectionism. And let's not forget about technological disruption, which we believe will structurally raise the unemployment rate, which is never good for sentiment. While the piece goes on to cite research showing that countries governed by populists suffer lasting economic damage with lower incomes and greater instability, we would point out that countries that promote economic dynamism, efficient market-based capital markets, and enlightened regulation can spur on superior growth. All right, on to our third thing, biggest risks. Now, Deutsche Bank Research conducted a survey of its clients in mid-December, to which 440 responded, including yours truly. When asked to name up to 3 factors that pose the biggest risk to market stability in 2026, only one was mentioned by more than half of respondents. That tells you there are a lot of different things out there on the risk front. The risk cited most, at 57%, is concern over tech, that valuations plunge and enthusiasm wanes for AI. For what it's worth, we're in that camp. The vast majority of U.S. economic growth in 2025 came from the tech sector. The sector drives growth in 3 powerful ways: CapEx in building out AI infrastructure, investment in CapEx and people by companies using technology, and the wealth effect coming from stock market gains that have been overwhelmingly driven of late by the promise or hype around technology. The return, the magnitude, as well as the timing on that investment is very much uncertain, and yet valuations leave little room for error or even moderation, and a correction in equity valuations will surely spill over into credit. The second most cited risk, by 27% of respondents, is the new Fed chair pushing for aggressive rate cuts. We are not in this camp. We believe the Fed's voting process as it stands today and the governor that is the bond market serve as effective guardrails that will keep the central bank data-driven and incremental in its policy initiatives. The third most cited risk is a crisis in private capital, mentioned by 22% of respondents. Well, we are among the 78% that are not worried about this. What would a crisis in private capital look like? Well, it's hard to imagine given the very nature of private capital. The markets are huge and extremely well diversified. What would constitute a crisis? A massive shock to valuation. And that's hard to imagine given that there's not a significant concentration of risk that has been systematically underwritten poorly, in our opinion. Returns might suffer, but the risk of contagion spreading broadly throughout the economy we see is very low. The other 2 risks we chose are related: stickier than expected inflation and bond yields rising more than expected. Now, no one likes inflation, except maybe those holding hard assets. I suppose inflation is a real bugaboo that sows discontent and wreaks havoc in financial markets. And as mentioned, there are seeds out there that could reignite price pressures. Inflation is one thing that could bring about higher bond yields, along with investors reducing exposure to the U.S. for geopolitical or debt and deficit reasons, or just asset allocation adjustment. Any of those could drive bond yields higher in 2026, and that's never good for fixed income returns. So there you have it. 3 things in credit. 1, bond vigilantes. They've resurfaced, but we don't see them turning on the U.S. 2, the cost of gloom. Widespread dissatisfaction can lead to growth-sapping political change, but economic dynamism is an important antidote. And 3, biggest risks. Watch tech earnings and guidance, and keep an eye on that bugaboo, inflation. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.